Hi everybody, this is Patrick Zielbauer from Infinity. Thanks for taking a look at today's video. Today's video is especially relevant because we're going to talk about slippage. Okay, slippage. It's this nasty word in the trading business, and the word slippage has different meanings for different people, but the real meaning for people in the trading community who understand the role of a brokerage in the transaction, slippage has a very specific meaning. And the meaning is the difference between the price you put your stop at and the price you get filled. So the market's at 100, you put a stop in at 95, the market goes down to 95, you get filled at 93, you get 2 ticks of slippage. What do you do when that happens? Okay? Well, that depends on who you are. All right? If you understand the role of the broker in the transaction, you probably do nothing. But if you're unsure why that has happened, that may trigger a phone call to me. And that's when we have a discussion that is prompting me to make this video, because we have seen some slippage in these volatile markets in the last couple of weeks, specifically. Not to mention with the rollover, kind of coinciding with volatility in the indexes, the rollover being the switch from September to December, which is basically fully completed as of today. And that's what I want to discuss. So I'd like everybody to look at these 4 domes here. On the far left, we have the NASDAQ, that's the December contract. In the middle here, we've got the December 10-year note. This is the November heating oil contract. And then this is November crude on the far right, which is the current front month for crude. Now, when you look at these domes, what do you notice about the bid and offer quantities in the blue and the red column? Well, you probably notice that they are very different on each market. And the biggest disparity is going to be on something like the 10-year note versus heating oil. Look at the differences in those values. These are in the thousands, and these are in the low single digits, if at all. There are some clear areas that have no bid or offer. All right, this market looks a lot jerkier. There's not as many participants, and that's really the source of that. So let's try and understand what the trade-off is between liquidity and slippage. Liquidity has a very positive connotation in the trading community. Liquid, easy to get in and out of, lots of participants, great fills. Okay, liquidity is usually a positive thing in the context of a trading discussion. But for traders who seek volatility, liquidity is not always what they are looking for. All right, I'm going to try to give you a even clearer example, more of like an extreme example of ultra liquid markets. Give me just a second to find it. We're looking for, let's call it the front month of, or the December contract of the euro dollar. Okay, the euro dollar, not the euro futures. This is the euro dollar, meaning this is a interest rate contract. Look at the liquidity. 16,000 contracts, 17,000 contracts at 97.97. Okay, so if we all just wanted the most liquid market, we would all just trade the euro dollar, or we trade something like the 2-year note. But those markets don't move. They don't move because they're so liquid. There's so many participants that for the market to get to the next price, it's got to chew through so many orders. Okay, illiquid markets are generally attractive to intraday traders. Crude oil, the Nasdaq, these are markets that are kind of liquid. Look at crude here, 35, 6, 40 contracts on the bid or the offer. The Nasdaq, okay, over here, 7, 2, 3, 4 contracts, 31, 28 contracts on the bid or the offer. Okay, compared with, let's say, the E-mini S&P, which has usually several hundred. Okay, this is the current December contract as well. All right, so liquidity is something that drives execution quality. In a market that is illiquid, you're going to get a lot of movement. And in a market that is very, very liquid, generally speaking, you're going to get less movement. But there's a trade-off between volatility and execution quality. I had some questions come up last week and earlier this week about slippage in the NASDAQ. Patrick, how on earth can I get 2 points of slippage in the NASDAQ? That can happen. If there is a spike in the market, understanding what is happening with the order is important to understanding and accepting that that's just a reality of trading. Okay, so when you put a stop order in on our platform, it goes and sits on Globex, which is the CME's order management system. Once that order is elected, it effectively becomes a limit order way past where the market price is, which effectively feels like a market order to you. It's actually not considered a market order. Some people use the phrase stop market. It's really not a market order. It's actually a stop with protection is what the CME calls it. They place a limit order a certain number of points away from the market. It gets filled immediately at whatever the current available price is. That price is then relayed to us, and we post that to the platform, and that's where you see your fill price on the software. So what is Infinity's role, or our parent company in this case, Transact's role in the transaction? All right, the order is simply routed to the exchange by Transact, and then it just sits there, and we wait. We wait. It gets filled. The CME puts a fill price on the order, sends it to Transact. Transact forwards it to your platform. So we don't hold the order somewhere or cause the order to be executed at a better or a worse price. It is very difficult in the brokerage community to explain this properly because people think maybe the brokerages are making the market for the clients or whatever the situation is. That is absolutely not true, especially in our case. All the orders are actually held at the exchange, but if the market is ripping through your stop price, or even if it's not ripping through your price, but if there is a large amount of volume that trades right through your order at kind of a random period, like something in the evening or something early morning or kind of a dead spot in the middle of the day where there's not a lot of liquidity at that moment and someone throws in a big order and it rips through the stop, that is where you're generally going to see slippage that feels abnormal. So there's really nothing you can do about it as a customer. You just need to be aware of the reality that can happen. And it's important to understand that the best chance, in my opinion at least, of best execution is to have your order sitting on the exchange. There are a couple of firms I know of that have options of holding your order off the exchange, like with the broker's server. That to me is a infrastructural problem, especially if they don't tell you that it's happening, because that means that when your stop price is touched, they actually have to send the order to the exchange at that time. Well, a lot can happen in that time. What if there's a huge move in the market and that hypothetical example we gave you a moment ago, you're long from 100, stop at 95. When 95 prints, they then send the order to the exchange. What if the market's at 85 by the time it gets there? That's, in my opinion, where you're going to see the worst execution on a relatively common basis. So, there are a couple of firms I know of that do this. Obviously, I can talk to you about my experiences with my customers who report that kind of thing to me. If you want to address it with me personally, of course, I would be welcome. I would welcome that conversation. But with our platform, everything is sent to the exchange. All right, there's no way to really eliminate slippage using a stop with protection order at the CME. Some people will say, well, why don't you use a stop limit? A stop limit is like a stop order with a limit price where if the market doesn't trade in between those prices at all, then it just gets jumped. Well, the answer should be obvious. You're much more likely to get jumped. If you do not want to use a stop limit order as a stop loss, because if the market jumps that distance between the stop and the limit without trading in between, you could be in some serious trouble. You're basically left exposed. So again, liquidity is a big deal. When it comes to order execution quality, when you trade markets that are moving very fast or that are very thin, execution quality will suffer a little bit. The trade-off should be the volatility you seek is there, and hopefully, that can compensate. All right. There's another thing I want to touch on as well, is crude oil is a good example of a market that trades a lot of volume, but is not necessarily that liquid. Okay, it's traded 300,000 contracts today, which is a lot. There's a lot of that is residual from the news of the weekend about crude getting spiking as a result of the attack on the Saudi oil facilities. But crude oil is a good example of a market that trades a lot of volume because there's so many quick hits in that market, but it's not actually extremely liquid. Okay, so don't confuse just volume alone with liquidity. They are linked in a lot of cases, okay? But in the case of crude oil, that is an example of a market can trade very, very, very heavily and still not be that deep in terms of the order book, in terms of the liquidity. So I hope that is clear. I understand, slippage is not a fun thing to talk about. Most people don't, brokers don't want to talk about it because, especially publicly, because it could give the impression that, somehow, they're doing something to cause this. That's not true. Okay, the orders are at the exchange level. That is the best way to have your orders held and the safest, in my opinion. You know, this alternative of having the orders held on some server somewhere. What if the broker server goes down and they just never get the order in? They're going to refer you to that electronic trading agreement you signed when you opened your account. There are risks that can't be mitigated in our business. In my opinion, that is one that can be mitigated by the orders sitting at the exchange. I think it's the safest option for traders. So I hope again that is clear. Again, liquidity, volatility. There are trade-offs between liquidity, volatility, and execution quality. Bear that in mind. If you're going to trade a super thin market, you got to bear in mind the execution quality might suffer a little bit, and you have to build that into your strategy. If you trade a market that you normally don't see a lot of slippage in, and if you trade the Nasdaq or the S&P, and it's not usually a problem, great. But just understand that every now and then, in a weird anomalous situation, it can happen. It's part of trading, and there's just not a whole lot you can do about it. All right. Thanks again for listening. Hope it was useful. We'll see you again next time.